صغيرة. ومثل ما بتعرفوا الويبينارات تبعول المعهد دايما ريكوردد تيتيحوا فرصة للناس اللي ما قدروا يحضروا أو اللي تسجلوا ما قدروا يحضروا ويرجعوا يتابعوا الدسكشنز اللي بتصير. اسمحوا لي انتقل للغة الإنجليزية وبدي أتشكركم كمان مرة تانية لمواظبتكم على متابعتنا. So thank you for joining us today to discuss a matter that one way or the other has a direct impact on all our lives. Lebanon, as you all know, stands at a pivotal time, not only trying to come out of a compounded crisis that has decimated its economic, its social fundamentals, but also, and this is more important, to heal from a devastating conflict that left significant physical and mental scars on us. As you probably know, but this is the latest figures that I got while working on a paper on the governance of mental health, which we discussed recently in New York at the United Nations Committee of Experts on Public Administration. 1 in 10 of a person living in conflict zone is severely affected by mental scars. And in Lebanon, the numbers show that 3 over 5 persons, and this is a big percentage, 3 over 5, suffer from one form of another of PTSD or post-trauma disorders. And this affects, of course, economic productivity, but also social cohesion and has lots of implications on the eventual peacefulness of society. So to pave the way, we certainly need to understand exactly where are we standing today, not in terms of mental health, because I will relegate you to the paper I wrote and published, but also important to know where we stand in terms of cost of reconstruction. And we have today a very interesting document, the Lebanon Rapid Damage and Needs Assessment, which has been conducted at the request of the government of Lebanon by the World Bank, and for the first time in collaboration with an esteemed national institute, the National Council for Scientific Research. So this key document is not only an important assessment of the 2023-2024 war on Lebanon, but also it is a guide, evidence-based guide for policymaking to get out of the very difficult situation we are in. The report estimates the impact of conflict in terms of physical damage, but also economic losses. And what is important is that it identifies preliminary recovery and reconstruction needs over the immediate, the short, and the medium term. So you have an assessment of both direct and indirect impacts across different sectors, and the 10 sectors will be discussed. Our discussant will present them to you, and I'm very happy to have today 2 persons that were major contributors to this important work. Philip Peterman, Senior Disaster Risk Management and Resilience Specialist at the World Bank, and Philip is the team lead on the RDNA, and of course our dearest Dima Krayem, Senior Economist at the World Bank. So I am very eager to hear from them, just as you are, and it's not only the assessment that we are interested in, but the macroeconomic implications, and this will guide us to understand better what is required for sustainable and reform-driven economy. So with no further ado, I leave the floor to a much worthy colleague from the Institute of Finance, Ms. Sabine Hatem. She's the chief economist, as you know, and the director of cooperation and partnership at the Institute. Sabine is a brilliant person who has been accompanying a lot of the economic reports, and specifically on budget, but also on social protection. And she's very much the liaison between the Institute and the World Bank. So Sabine, the floor is yours to guide us through today's important discussion. And a big thank to Philip and Dima again for your time. And thank you for all those who are attending the webinar. The floor is yours, Sabine.
Thank you, Lamia. With no further ado, I will start because it's just a 1-hour webinar, so we'll try to make the best out of it. We have a lot of questions to ask to both Dima and Philip. I will start my first question to Philip. In the rapid damage need assessment that was published last month by the World Bank, the report estimated that the economic cost of the conflict on Lebanon was about $14 billion. So we would like to start by maybe unpacking these figures, understand what were the sectors that were the most affected, what about the geographic distribution of the losses. So if you can give us like an overall idea of how this number was, calculated. And I just want to tell all participants that we have just posted the link to the report in case they wish to have a look at it. So Philip, first question to you.
Thank you so much, Sabine, and welcome everyone. It's really a pleasure and an honor to be amongst you today. We actually have prepared a very short presentation that I think will answer some of the questions you already asked, Sabine, and also provide a larger overview of the assessment to kind of set the context, both on the report itself and the damage, loss, and needs numbers, but also on the macroeconomic impact that Dima will touch upon. So I'm just going to share my screen, and we'll go through that for 5 to 10 minutes, and then I'll come back to your questions, and we can go from there if that's okay. Can you see my screen?
Yes.
Yes.
Yes, now we can see.
Okay, great. So the assessment, and some of you might have already seen it, was published last month in early March, and it was based on a request from the government that we received mid-December last year. So it was a report that we prepared under a very expedited time frame in 2 to 3 months, and we worked very closely with the National Council for Scientific Research. So this is one of the first times we really collaborated very closely on this type of assessments with a Lebanese institution, and that was really important because it helped us corroborate a lot of the information. I'm going to touch on that in a second. The objectives initially of that assessment were really threefold. It was to give us these 3 big outputs that Sabine already mentioned: the damages, the losses, and the recovery needs, but also a broader objective of really trying to inform policymakers on recovery priorities and help them in the recovery planning process at a really critical time for Lebanon. The scope is very comprehensive. We covered 10 sectors that you can see on the left. In addition to that, we also looked at the macroeconomic impact. We looked into displacement impacts. The time frame covers pretty much the entirety of the conflict from October 8, 2023 to December 2024. We're fully aware that there are some conflict incidents that took place after that and that unfortunately could not be covered, but it does cover a significant amount of the conflict, and it covers the entire country. The assessment methodology is adapted from the post-disaster needs assessment methodology that was developed by the World Bank, the EU, and the UN, and has been adapted in many cases to conflict contexts. You can see on the top right that we've done these type of assessments in very different setups, in both disaster and conflict settings. Most recently, we published one for Gaza. We have done one for Ukraine. So there's a lot of experience and expertise that we've built over time to do these type of assessments, even in settings where we don't have full access to the ground. And we're doing that partly by relying on a hybrid 2-tier methodology that mixes ground-based and remote-based data sources. So ground-based data is really, data we, for example, received from CNAS Lebanon, from ground surveys, from key informant interviews. And we are complementing that with remote-based data through high-resolution satellite imagery, radar data, cell phone data, social media analytics to fill gaps, validate, and corroborate the information. Before we go to the findings, I just want to pause quickly to just explain 3 key definitions that are important for this assessment. The first one is damages, and with damage, we refer to the replacement value of partially damaged or destroyed physical assets. So this is really a backward-looking indicator. You look back to see what has been damaged and what was the cost of that. And we're using pre-conflict replacement costs. So we're not bringing the prices up to the current level. The second key term is losses, where we're referring to the changes in economic flow that result from the interruption or reduction of production and services due to the conflict. So those are not physical damage, but they're a little bit more, you can think of indirect impacts. And they are both backward-looking and forward-looking. Forward-looking because some of these losses keep accumulating as some of the productive services or business activities cannot continue in the future. So those are estimated over a period of 26 months, covering the 14 months of conflict from October to December that I showed earlier, as well as one recovery year, assuming that at some point recovery sets in and the losses dissipate. Those are valued at current prices. And then we have needs, and they refer to the cost of rebuilding assets and restoring services and business activity to the pre-conflict level. So that covers two main elements: infrastructure reconstruction, which is directly linked to the damages. So if you have damaged a building, a house, a school, how much does it cost to reconstruct it? And also service delivery and business activity restoration. So how much is needed to bring, for example, the business community back to speed. We usually include here a premium for building back better. So we're not just replacing what was damaged, for example, but we're reconstructing it to a better level to make sure that it adheres to more modern design standards. It is, for example, disaster resilient, it is greener, etc., more sustainable. And needs are valued at current prices. And for this assessment, we then distribute needs into a short, medium, and long term, or immediate, short, and medium term. And needs are inherently forward-looking, right? So this is really what it costs the country to rebuild the different infrastructure assets. So damage and losses are basically describing the conflict impact, and needs are really describing what it costs forward-looking to reconstruct. Now, those are the key findings of the report. So the conflict impact, meaning damage and losses, are roughly estimated at 14 billion, and we have needs roughly estimated at 11 billion. How do those get distributed across different sectors? On the damage side, you see that most of the damage, close to 70%, is focused in the housing sector. And that's very consistent with these type of assessments, because the housing sector has so many assets that have considerable value that it just drives a lot of the damage costs. We also have around 700 million of damage in the infrastructure sectors, covering energy, municipal service, transport, and water, and around 600 million in the commerce, industry, and tourism sector. So that covers, business establishments, hotels, tourism industry, etc. On the losses, we see a slightly different picture, which makes sense, right? Here, the biggest impact is on the commerce, industry, and tourism sector, which really has been hit a lot, with losses estimated at close to $3.5 billion. We also see a lot of losses on the environment, as well as in infrastructure and also in agriculture, which obviously has been impacted a lot in the south. And geographically, throughout, what we can see is the most affected governments are always Nabatea in the south, as well as Mount Lebanon, because Mount Lebanon includes the southern districts of Beirut. Now, moving on to the needs, those are distributed, again, primarily in housing, with around 57%, so that's 6.2 billion. We have a lot of needs in infrastructure with around 1 billion, and a lot of needs as well in the commerce industry and tourism sector with 1.85. So those are the big ticket items in a way. And again, geographically, you see the three governments I mentioned. So this is just there to give an overview. We can go a bit deeper in the discussion, and I'm now turning it over to my colleague Dima to cover quickly on the macro impact.
Thanks, Philip. Philip, do you mind unsharing so I can share? I've changed, I've made some last minute revisions. Can you all see my screen?
Yes. Yeah.
Great.
Yes.
So, Sabine, I don't know if you want to start with a specific question, because I think I've...
No, it's okay. Let's present also the macroeconomic impact and also explaining also what it means for the country, just so you know that everyone understands the rationale behind the numbers.
Absolutely. Okay. All right. So just a couple of caveats before we jump into the numbers. So our assessment, our macroeconomic assessment of the impact of the war on Lebanon is complementary to the study, the RDNA, which Philip read. Which Philip led. So the idea here is that we cannot add up all the sector impacts that Philip just presented to this macroeconomic impact. This is a totally different methodology that deals with the whole economy, but is meant to give, a picture of the impact, the devastating impact of the war on the broader macroeconomy. So just a caveat on that. That being said, I think, in addition to the devastating human toll, casualties, injuries, the mass displacement, I think it's important to situate the macroeconomic impact of the war within the broader context that is very much a lived reality, which is the multi-pronged crisis for the past 7 years. What we see here is for a period of 7 years, so since 2018, you've had continued economic contraction, a historic crisis, as you are all aware, and it's a widely lived experience, which has just been exacerbated by the most recent war. So our estimate of real GDP contraction for 2023 is 0.8%. And that largely takes into account just the last 3 months of the year of 2023, so October 23 to December 2023, which when the war on Gaza started, and you saw an indirect effect of a dent in tourism revenues in Lebanon. So that's what we primarily factor in 2023. Of course, the story changes in 2024, particularly with the escalation in the war starting in September. And this is why we have more recently updated our estimate for the 2024 contraction to a 7.1%. Now, I'll say more about those numbers, just to make them feel a bit more real than just numbers we're throwing at the audience. But just to give an idea about the magnitude or scale of where we're at the moment. So the total contraction since 2018 has approached 40% in terms of real GDP. So if we want to think about it differently, we're close to 2000, we're back to 2005, 2006 real GDP levels. So almost 20 years ago. Okay, so one thing we've done, and this is what's published in the report in the RDNA in terms of the macroeconomic assessment, is we've tried to isolate the impact of the war on the Lebanese economy. And what we mean by that is, the impact of the war can be more than just your estimate or contraction for 2024. There are a lot of factors in play, right? But what we've tried to do is construct a counterfactual, which means in the event that you did not have this war, what would our growth figures have been in 2023 and 2024? And what we find is interesting, but also needs to be treated with a lot of caution when it comes to analyzing those numbers. Growth would have been positive in both years, in 2023 and 2024, had there been no war. 0.2 in 2023, 0.9 in 2024, respectively. And how we've constructed this counterfactual is by looking at, the slight pickup you saw in economic activity in 2022 and assuming it continues on to 23 and 24, particularly in terms of tourism revenues, sustaining remittances, but again, and pickup in consumption, so moving towards pre-conflict trends in consumption. That being said, brings the total impact of the conflict to -8% in 2024. That being said, I think one of the most important points to make here is that we are not at all saying that in 2023 and 2024, absent the conflict, you would have seen an economic recovery. Just because you see a positive number does not mean that we were on a path of any sustainable or meaningful economic recovery. But to the contrary, the idea there is that the economy the contraction was bottoming out in the sense that there's only so much an economy can contract. In fact, only a war, which unfortunately materialized, would have caused a sharper contraction than what we have witnessed until the end of until 2023. So the idea here is that there's a base effect, which, given the baseline of a very sharp contraction, close to 34% of real GDP cumulatively prior to the war, you saw a bottoming out. And you saw a slight rebound in tourism. We're not talking about a change in an economic model or any meaningful reforms. But again, the main driver remains tourism, which is very susceptible to external shocks. But even in the absence of war, you had a lot of structural deficiencies that remained, be it the insolvent banking sector, the chronic current account deficit, relative to pre-crisis level, the erosion of public finances, no new monetary framework, etc. So it was very much an economy still exposed to any erosion and exogenous shock, which unfortunately materialized and only deepened the crisis. Now, one of the more important questions here is what are we looking at long term in terms of the impact of the conflict? Consumption and tourism, as you know, are always, expected to bounce back in the short term. So the minute the war ends or you have a meaningful, sustainable ceasefire, you will see a rebound in terms of tourism and also consumption. But the main issue there remains the rebuilding of the capital stock. And rebuilding capital stock is contingent on financing. Given the losses, the damages, the needs that Philip just mentioned. What we saw in this war, and that was more quantified in the RDNA, is destruction of infrastructure, but also yet another episode of skilled labor outflows. And what we're stressing on is that this affects long-term growth potential. And your potential GDP moving forward. And the idea here is, unfortunately, in the past 6-7 years, whatever the exogenous shock is, you end up with the same recommendations. That Lebanon remains cash-strapped in the absence of debt restructuring, you're axed out of financial markets, your debt to GDP, your debt sustainability is eroded, your banking sector remains insolvent, which is a major barrier for any financial inflows or any investment. Public investments are not feasible at the moment because there's no fiscal space for any capital expenditure, which further erodes capital stock in the long term. Private investment in such circumstances and under good conditions also remains unlikely. It's neither a favorable investment climate nor a competitive investment climate. So again, really end up with the same recommendation, which is credible reforms for the 6 years in a row. They just gain more and more urgency every year. And we can speak more about why reforms have not been implemented, whether or not we're going to be cautiously optimistic moving forward. We should be or should not be cautiously optimistic, particularly in terms of, banking restructuring or resolving the sovereign debt crisis. I think, Sabine, I'll leave it there and maybe then come back to the slide on outlook. I don't want to jump ahead. So what do you think?
Yeah. Oh, okay. Let's. Thank you both for the very interesting figures, and for the explanations around it. Before asking the next question, of course, I want to invite all participants to. We'll open the floor shortly for your questions, but also feel free to drop any question you have in the chat as well. I have building on what you just presented. You said that the needs reach around $11 billion, which is a very sizable amount. And Dima, you mentioned all the structural obstacles and challenges and deficiencies that Lebanon still face today. So if we're going to start looking forward, how can we plan the way forward? What would be the priorities based on the figures that you have today and the diagnostic that you presented? What, let's say, should be the priorities for the cabinet today, based on the diagnostic you've made? I leave it up to you, Philip or Dima, to both answer.
Yeah, let me come in here, Sabine. It's an excellent question, because the 11 billion number, right, is quite scary for a country where the government budget is significantly below that amount. So how is that going to be possible, and to be also provided in a relatively quick time frame, right? So it all really comes to prioritizing the areas that really bring the most value for the recovery investments, right? And one way we can look at this as well is from splitting these 11 billion into what traditionally becomes publicly financed, and what are recovery needs that are traditionally much more privately financed. And if you look at this from that perspective, what we can say is that the public financing is probably around 3 to 5 billion. That's the amount that would be needed to really, bring the economy and back to that pre-crisis level. And the rest would be much more privately financed. For example, look at the housing sector, right? It's unrealistic, and this is in no recovery experience that has happened, that the public sector comes in and rebuilds every single house. A lot of that will be privately financed. There will be probably a public component to it through some subsidies to incentivize the recovery of the housing reconstruction, but it's not going to be a fully public scheme. And the same can be said for the needs in the commerce and industry sector. There as well, it's probably there will be some public incentives, but it's not going to be everything publicly financed. So that's the first we need to keep in mind. So the 11 billion doesn't mean that the government needs to find 11 billion. The number for the government to find is a little bit less. And the second element is really, where do we have the biggest impact, right? And what we see in these contexts from a global perspective is that in the early recovery phase, what's really critical is to bring back what we call lifeline services and infrastructure. So really focus on the 1 billion of needs in the infrastructure sector that I showed. So this covers energy, it covers water, it covers municipal services, it covers transport, because those really have a ripple effect, right? You need to bring electricity back up. You need to bring water service provision back up. You need to bring road access back up in order to actually be able to recover on the other sectors of the economy. So focusing on these lifeline services and infrastructure in the immediate phase is absolutely critical. And another precondition even for that is the debris removal. So in a lot of cases in Lebanon, you simply can't do anything unless you first start to remove the rubble. And I know the government is doing its very best to already start with that, and it's an ongoing process. But that's really the priority number one. Then I would say really focus on the infrastructure and primarily on those lifeline services that are really critical, that have these interdependencies with other sectors, and then move to the other category of needs.
Thank you. You mentioned that the public finance recovery needs would be the recovery needs that the public sector, we need to finance are about 3 to 5 billion. But Dima also mentioned the challenges, ahead, the macroeconomic challenges ahead. So what does the way forward look for Lebanon to mobilize this amount, this type of financing? And is there really a possibility to unlock many financial sources domestically or from the international community? I'm sure there are requirements for us to be able to unlock those types of financing. So what are they?
Maybe I start, but then would be good to get Dima's perspective. You're right. The 11 billion needs number, you cannot find that just in Lebanon, right? So I think it's very clear that there needs to be some sort of foreign assistance and support that's going to be provided. And I know the government is in talks with our institution about that, and with a lot of other donors in the region and beyond. One element that's, I think, really critical for that type of support to materialize is credible progress on reform agenda around governance, anti-corruption, and transparency. And that's how at least our institution has been positioning our support. So I know there's a emergency assistance project that's currently being discussed that would focus a lot of its support in these lifeline services that I just outlined. And for that to materialize, and especially also for other financing institutions to buy into that approach and into that process, I think the critical element is really some of the reform elements that the country has been missing over the last years. And we really see now a window of opportunity for those to materialize. And I think a lot of the funding would be coupled to that progress.
Dima, would you like to comment?
Yeah, please. Okay, just to take a step back here and be very candid in our response, beyond just agency-centric politics and what we're doing and what we're not doing. If we look at Lebanon and the conditionalities that are put on us today, they are both political and economic. I think the political conditionalities, concessions, whatever you want to call them, are quite clear for everyone. Have to do with sovereignty, or state control of arms, 1701, etc. And I think we all have to contend with the arduous situation that this ceasefire is very fragile, given the continued attacks on a daily basis, which, in addition to all the impact on displacement, the fact that close to 100,000 displaced cannot go back to their villages, there is also an economic impact of this volatile environment and security situation, which would hinder even a tourism rebound in 2025 if left unresolved. Now, this is the political. It's no secret. I think we're all living it. We hear it every day. On the economic and like I mentioned in the slides I put up, those are long-standing reforms. But I think the main message here, and if it's anything, we've learned the past 7 months, is that the past 7 years, is there's no piecemeal solution here. So we cannot pick and choose which reforms we decide to embark on. Those reforms, we keep on calling them reforms, and this is just to humanize this word. We're in the next economic monitor, which should be issued next month, we're releasing 1-year policy action plan, which dissects by sector what is meant by reform, what is the policy action that is feasible within 1 year for a government with such a short tenure, to make strides of progress in terms of those reforms that are required. That being said, I think the absolute prerequisite is macroeconomic stabilization. And this is why we see under this government that they've started with the most urgent reforms, which are the banking secrecy law, which is a major reform necessary for any proper for safeguarding the bank restructuring process. The banking sector reform law, I think this is what they call it now, which was just approved by the Council of Ministers 2-3 days ago. And now we're going to start with the most contentious of all, which is the financial gap law, or the allocation of financial losses. So stakes are very high here for this reform agenda to actually succeed. And there's a lot of political pressure on the Lebanese government and authorities to actually move forward with this, as in, not stay with the policy of no policy that protects vested interests, as is the case in the past 7 years. So that, just to say, first, the prerequisite is this macroeconomic stabilization, obviously along with a new monetary framework. Yes, the exchange rate has stabilized. Whether or not it's volatile, a lot can be said about that. But I think for us, the main worry that we keep, reiterating is that this exchange rate stability seems to hinge on fiscal restraint, which to us is not sustainable, in the sense that what the key to this stabilization, at least what the BDL authorities were doing in the past year, was with this revenue, the increase in revenue mobilization and your ability to collect more revenues, you're controlling currency in circulation, and this is helping the stabilization of the exchange rate. But this is only possible if you put restraints on spending of public sector deposits at BDL, which is what we see really when you look at the increase in public sector deposits at BDL. And I forgot the percentage year-on-year increase, but it's quite obvious. So again, this is the prerequisite. As Philip mentioned, we're talking about governance, anti-corruption, judicial reforms as well. But also, I also want to stress on the fiscal side of reforms, the creation of fiscal space for social protection spending, and progressive tax system moving forward. I mean, the issue with Lebanon and the frustration, I think, for everyone that's working on Lebanon, is those reforms that we keep mentioning seem timeless. They equally, they equally hold 20 years ago. I really hope they will not hold 20 years from now. But really, this is the main frustration. Just to go back, I think I digressed a little bit, but just to go back to your question, I don't think practically we are looking at any meaningful financial assistance in terms of reconstruction, money coming in without, and it's become clear, and it's becoming clearer every day, without those political concessions, conditionalities, but also it is now more than ever tied to our economic reform agenda as well. That being said, even the 3 to 5 billion from public financing that Philip just mentioned seems like a daunting task at the moment, without any medium-term, fiscal framework, without debt restructuring, putting that debt back on a sustainable footing, and the creation. When you create fiscal space, there's going to be competing priorities. Let's face it. And one very important priority is going to be reconstruction, obviously, but also safety nets, services, etc. Social services, public utilities, etc. So, when we say 3 to 5 billion, I think that's 100% of expected revenues in 2025. So I'm also very cautious about our ability to create this much fiscal space in the immediate or short term. We have to, for all practical purposes, rely on foreign financing, grants, for sure, preferably also, if we really have to, concessional loans, kind of what we are doing at the moment. But I think a lot of it has to be external financing and investments. So creating the climate for better investments. I'll stop there.
Thank you. Thank you for the comprehensive overview. I'm going to open the floor for questions. Please, whoever have a question can raise your hand and ask it. No question from the floor.
في عالية.
Oui, sorry, go ahead, Alia.
Hello, can you hear me?
Yes, we can.
Yes.
Yeah.
Yes. Hi, everybody, and thank you for this very interesting presentation. More information always helps us try to better understand the framework. So I have a couple of questions. I mean, on the assessment. So when you're saying 3 to 5 billion, we are talking mainly of the public infrastructure, but if that's what you mean, so internally generated or possibly also externally financed. I assume both of it, if I understood well how you presented it. So I just wanted a confirmation. But also your sense, I mean, looking at the broader global environment, the priorities, the fact that the whole world has many post-conflict countries that are lining up and for competing for international support. I mean, what is the appetite for the international donor community and your assessment of how Lebanon compares to Ukraine or Gaza or Yemen or Syria, etc., etc. So that's if you have this global view. And the second related maybe also to Dima, because it relates to the external financing outlook of Lebanon, which already is in a very dire situation, both in terms of the fact that the BDL is in deep negative equity, and the current account deficit is extremely large compared to our ability to generate dollars. So, and if we look at past experiences of post-conflict reconstruction, particularly also in Lebanon, we always see that post-conflict is associated with widening of the current account deficit, which could exacerbate the problem and actually make the whole process of both I think financial sector and debt restructuring even more difficult. So the question is here is, did you have an opportunity or to look at this correlation between post-conflict reconstruction and current account dynamics, and what do you think should that mean for exchange rate policy actually? Because that's the big question.
Sabine, should we answer or?
Yes, go ahead. And if anyone has another question, we'll give the floor later.
Okay, let me start, and then specifically for the last question, I think Dima is better placed than me to answer. Yeah, thanks, Alia. Great questions. the 3 to 5 billion are not related directly to public infrastructure. So basically, when you look at the 11 billion, the question that we try to answer is, okay, what is the source of financing likely to be, right? And for some of these sectors, let's take education, health, so the human development sectors, but also, covering the needs in environment, agriculture, as well as infrastructure. Those are very likely to be covered by the public sector. So that's the 3 to 5 billion. And then we have the remainder, which is 6 to 8 billion, that we expect to be much more financed through the private sector. And that's mostly in the commerce, industry, and tourism sector, but also in housing. Now, that doesn't mean that commerce and industry or housing will not see any public funding at all, right? But it does mean that the bulk of the needs would be covered likely through private financing. On your second question, what's the appetite of the donor community? I think it's as Dima mentioned, I think it's really a difficult scenario right now. And I think for two reasons. The first one is that we just have a lot of very similar situations right now and limited international resources, right? So the overall appetite for development financing right now is not great. Then we have the situation that there are recovery processes ongoing in Ukraine, in Gaza, in Lebanon, and all of them are ultimately competing for money against each other. So that's just a reality. And that's why, for those reasons, I think it's going to be even more important that the Lebanese government is going to embark on that critical path towards credible reform in order to unlock some of the donor financing. I think there is willingness from what I'm hearing, there is a lot of willingness to contribute and to support, but everyone is coupling that on the condition of seeing credible reform happening in the country. That's what we're seeing. Passing it over to Dima to complement, and then I think to answer the third questions on the correlation with the current account and the foreign exchange policy.
Dima, just before you start answering, there's also a question on using the gold that it has BDL because its value has been increasing in the past few months. So if you can also link it to your answer on the exchange rate and the monetary policy.
Yeah, sure. So thanks, Alia. I mean, as always, very challenging question and something to really think about. Funny you mentioned the 2006 reconstruction. So what we've done in the previous economic monitor that was out a couple of months ago is a small, this is just a summary of it, is a comparison between, a comprehensive comparison between 2006 and now. Be it the impact of the conflict, but also on the macroeconomic environment, just to show how challenging and different the reconstruction challenge ahead is, given the crisis, the fact that you have a volatile de facto exchange rate stability right now, the lack of foreign aid appetite, as you said, the lack of investment sentiment, which is almost the exact opposite of what you had in 2006, where you saw a growth of 9.3% in 2008. A lot can be said about that period. Of course, I don't mean to simplify the structural issues that existed even then. But just to highlight that this comparison is absolutely important to stress on why this reconstruction phase is going to be very difficult. That being said, I think to be very honest, we haven't done specific work on current account and post-conflict correlation. But my 2 cents would be is that in the context of a multi-pronged crisis, and if you actually embark on recovery, which is fueled by meaningful reform, your GDP will also significantly increase. So you do have a denominator effect there that can offset you know, the increase in current account deficit, which is funnily enough what we see in 2025. So in 2025, our outlook moving forward, we haven't yet published this, but we will soon. We're looking at a decrease in the current account deficit from 25% as a percent of GDP to 15%. And that's primarily because of this increase in nominal GDP. Again, another thing about recovery, which I understand, you know, the current account deficit would increase given primarily the increase in goods imports. But I think your trade and services balance, which historically partially offsets this trade and goods deficit, would also significantly increase, and this would also help offset the current account deficit. I think here, when it comes to the exchange rate, and for the second part of your question, we've done some analysis that we will be publishing next month on the real effective exchange rate. And I think, you know, and the fact that even when our RER appreciated in the context of the crisis, we didn't see an meaningful increase in exports. So why is it that, you know, this export, we weren't being able to leverage any export competitiveness? We look at the structural issues behind that, but also I think the elephant in the room is dollarization, widespread dollarization across the economy, you know, which limits any benefits from gains in or depreciating RER in terms of export competitiveness, and will also play a crucial role moving forward. I don't see dollarization. We are going to be able to de-dollarize even with a new monetary framework. I think it's a very difficult task. Just to say one thing on gold, there's a very big difference between investing in an asset, our gold asset, and just liquidating it to pay back deposits, which is one of the suggestions out there. I don't think, you know, as a concept, there's anything wrong with investing in our gold assets, but the issue again is governance, and your ability to trust any sort of investment in the absence of meaningful reforms in governance. Just to keep it general there. Yeah.
Yeah. Gonna take maybe one last question. If someone has something would like to ask for some clarification on specific points that were mentioned today. I know there was a lot of information, so because we have just like two minutes left. So if anyone has another question, please feel free now to ask it. No. Dima and Philip, any last words, concluding thoughts?
I think, you know, we maintain our cautious optimism. It's very cautious and very volatile, I must say. But there is a reform momentum, and there is a lot of political pressure for this reform agenda. So, yeah, let's see if things happen for us in the country. And thank you very much, everyone, and thank you for having us. And thank you so much, Sabine.
Philip, yes, go ahead.
Yes, no, Dima said it well. I think the next 6 months will be absolutely critical for the country to see where this recovery process is going. And I mean, it's so challenging because there's so many compounding factors going on, right? But again, as Dima, I'm cautiously optimistic. I think a lot of people are. And let's hope for the best, and we on our end are going to support as much as we can. And again, big thanks for hosting us, and it was a pleasure to be with you today.
It was a pleasure for us. Thank you again for all the information. It's true that there's plenty to be done and a lot of challenges, but we're seeing some some efforts being, let's say more dynamic approach to things. So maybe that's why we're a little bit hopeful, a little bit more than before. Again, thank you both for a very clear presentation, very comprehensive, and a very short and limited time. So it was a pleasure really to have you with us. I will check just if Lamia want to say some closing remarks as well, if she's still with us. No, okay. So thank you. I just want to also say to everyone that we will share with you the recording of the webinar, and it will be posted on our website. And we'll be sending you also our schedule for upcoming webinars that we resume, I think, in a 2-week time. So that's it. Thank you again, everyone, and have a very nice end of day. Or day for the people that are overseas. And see you soon, hopefully.
Thank you.
Thank you.
Thank you, Sabine. Thank you all.
Thank you so much.
Thank you all.
Thank you all. Bye-bye.